Hello everyone, welcome you all in the SST College of Arts and Commerce. This is the SST Edupedia. Myself, Aakash Jawrani, the Assistant Professor of SST College of Arts and Commerce. The topic that I am going to teach you today, that it is the business economics. This subject is for the second year BMS and second year BCBI semester 4 subject, and the topic that I am going to cover today, it is the balance of payment. This topic is in the module 4 of SYBMS and SYBCBI. So before starting what is balance of payment, let us see what is the country has to deal with the other countries in respect of the following. That is the what is country deal? Country deals in the visible items also and invisible items also. First of all, what is the meaning of visible items? Visible items are that items that we can see, we can touch. For example, I am talking about the electronic goods which we can touch. Okay, that are the physical goods. Means India is exporting physical goods and importing also physical goods. Exporting means to sell the goods to other countries, and importing means to purchase the good from the other countries. Next one is the invisible items. Invisible items are those items in which export and import are not visible properly. For example, transport services, medical services, etc. The items which are not visible in is called the services. Third one is the capital transfers, which are connected with capital receipts and capital payments. Capital receipt means income. The India in which the income is earning is called the capital receipt. If India is making payment, it is called the capital payment. Moving further with the next slide, that is the balance of payment. The chapter that I am going to cover is the balance of payment. So what is the meaning of balance of payment? We are seeing in this paper, it is written that balance of payment of a country is a systematic record of all economic transactions between the residents of the reporting country and the resident of foreign countries during a given period of time. So the balance of payment means what is the meaning of this? In which the economic transactions are done, in which the economic transactions are done of India and another country. It is called the balance of payment. Economic transactions which enter into the balance of payment record involve transfer of goods and assets or rendering services from residents of one country to the residents of the rest of the world. The balance of payment record is maintained in a standard double entry bookkeeping method. So it is written here that balance of payment, it is a transaction of one country to the another country, of one country to the rest of the world. So it is a transaction between the India and the different countries, that how much India is importing goods, how much India is exporting goods. Okay, so this is the balance of payment, and balance of payment is always in the double entry bookkeeping system. Now we are going to study the importance of balance of payment. Balance of payment records all the transactions that create demand for and supply of a currency. This indicates demand supply equation of the currency. This can drive changes in exchange rate of the currency with the other countries. So in which it is written that whatever India is importing, when whatever India is exporting the goods, it is creates demand and supply of the goods. BOP may confirm trend in economy's international trade and exchange rate of the currency. This may also indicate change or reversal in this trend. This may indicate policy shift of the monetary authority of the country. This may also shift the RBI of the country. So, general rule in the BOP accounting. The general rule of BOP accounting is if a transaction earned foreign exchange for the nation, it is credit and it is recorded as a plus item. The meaning of this sentence is whenever India earning foreign exchange, it is in the foreign exchange, it is credited to be the account, and whenever the India expenses, spending some items in the foreign exchange, it is a negative item, it is to be debited. So the next one is the various components of a BOP. The various components of BOP are written here. The first one is the balance of trade, second is the current account, capital account, okay, capital account. So the movements are there. We are moving further, that is the balance of trade. What is the meaning of balance of trade? I am starting, that is the balance of trade. The difference between the country's imports and exports is called the balance of trade. Balance of trade, it is the largest component of the country's balance of payment. Whenever the exports are greater than imports, balance of payment is favorable. A debit items like whatever debit items, whenever the India's expenses are written. For example, when India is importing goods from other countries, domestic spending abroad, okay, domestic investment abroad, etc. And whatever the incomes of the India are, exports, foreign spending in the domestic economy, foreign investment in the domestic economy, etc. So the next slide, that is the current account. Current account is a statement of the actual receipts and payments in a short period. The meaning of current account, it is a short period account. Whatever the actually India is doing in the present, it is called the current account. Whatever the India is exporting the goods or importing the goods, it is called the current account. It includes the value of the export and imports of the both visible and the invisible goods. There can be either surplus or deficit in the current account. The current account includes the export and import of services, interest, whatever the interest is earning, okay, profits, dividends from the share market, unilateral receipts, payments from to abroad, etc. Here the different word we are going to study, that is the unilateral. Unilateral is a one-way process. It is a one-way process. For example, if India is giving gift to another country, it is called a unilateral. Okay. So the next one we are moving further, that is the BOP on current account, refers to the inclusion of three balance of, namely merchandise balance, service balance and the unilateral transfer balance. So the next one we are going to study, that is the capital account. Capital account records all international transactions that is involve a resident of the country concerned changing either his assets with or his liabilities of a resident to another country. Whenever India is importing or exporting the assets, it is called the capital account. Transaction in the capital account reflect a change in stock, either assets or the liabilities. Is difference between the receipt and the payment of the account of capital account. It refers of all the financial transactions. The capital account involves inflows and outflows relating to investment, short-term borrowing, lending, medium-term to long-term borrowing, etc. The next one is the reserve account. Reserve account. There are three mainly reserve account, that is the IMF, HDR and reserve and monetary gold are collectively called as the reserve account. It is written here, the IMF account contains purchases credit and the repurchases debit from the international monetary funds. Okay, so these are the written here. Moving further, that is the errors and the commission. What are the errors and commission? Sometimes when we are importing or exporting in accounting, we make some errors or sometimes we make omissions. The entries under the head related mainly to relate to lead and lags in reporting of transactions. It is a balancing entry. It is a balancing entry of offset the overstated or understated components. So it is written here, the balancing must be there. The RBI is there. It is balancing the imports and exports of the country. The main foreign reserves are be maintained by the RBI. So thank you very much.